So the stock market is still crashing, while the US government is increasing tariffs against certain countries, even while putting a 90-day pause on some others. But with stocks dropping and rising and dropping again, there's a lot of uncertainty in the market. But with this kind of uncertainty comes huge opportunities. But which stocks will tariffs hurt, and which ones might they help? So I wanted to understand what is going on with tariffs, like what do they actually do, and then look at 3 stocks that may actually benefit from the current chaos by focusing on data over emotion. So let's start with what a tariff means in real-world words, not abstract. So tariffs are when a government puts a tax on any import or export from a country. That's all it is. You know how you pay sales tax when you check out at a grocery store? Well, imagine paying something similar at one of the US's ports when you're unloading a shipping container full of goods onto a truck. And historically, there have been 2 uses for tariffs, either to make the government some more money or to try to artificially shift trading patterns around, affecting what countries, people, and companies buy from. So that all sounds pretty mundane, but the effects of this can have huge and sometimes unexpected side effects, even on parts of the economy that aren't directly importing goods, which is where we might be able to find an edge on the stock market. So let's look at a concrete example of tariffs. Imagine your country grows a lot of coffee beans, and a big chunk of the population works for one of the big coffee companies in your country. But suddenly a new competitor company pops up in a different country that has more efficient methods that lets them undercut your company's prices. But your country can't afford to sell coffee at that price because they aren't as efficient, or maybe because labor is more expensive there. Well, since you can't compete at the lower price, your country could issue tariffs on all foreign imported coffee beans to protect your industries, effectively putting your finger on the scale to make it easier for companies doing business within your borders. Of course, this only affects prices in your country. Everywhere else in the world will probably be buying cheap coffee beans from your competitors. But maybe it's enough to save the part of your companies that sells coffee beans locally. But one of the downsides is it won't make the companies within your country better at competing internationally, since thumb on the scale tariffs only apply within your borders. And if there's other industries that were relying on those cheaper coffee beans, maybe like a coffee shop, well, those just end up being collateral damage to the tariffs, necessary losses to try to save your coffee bean growers. Now, one of the big issues people have with tariffs is there are other ways you could have helped those bean growers without as many unintended side effects. You could subsidize them, reduce their taxes, or fund research to help them grow their beans more efficiently. In fact, this is how the US has supported our country's agriculture industry for decades. But there could be situations where you would still want to use tariffs, and this can teach us about who will benefit and suffer the most from the current trade war. So historically, the US and other countries around the world use tariffs as a way to make money for the government. This is a chart showing how the average tariff rate in the 1800s often hovered close to the 50% line, with most federal revenue before 1942 coming from tariffs. But after the Second World War, the US started to promote global free trade, both as a way to reduce international tension, hard to have a World War III if everyone's economies are tied together, and because the US was emerging as the world superpower, and so global free trade gave the US soft power over much of the world economy. As this anti-free trade propaganda poster from the 1800s depicts pretty well, free trade and power can go hand in hand. But as the US's economic power grew, economists largely started to favor using income and payroll taxes to run the government, and tariffs became sidelined as a tool used mainly to punish other countries. It was a way to keep others in line using economics rather than warfare. But tariffs always came at a cost, the collateral damage that we talked about earlier. So this is the famous supply and demand chart that they taught us in University Economics 101. Yes, even the engineers had to take that class where I went to school, and I'll tell you what, the economics professors were way less intense than the engineering ones. And so this chart is a little weird at first, but it's a pretty useful tool for looking at situations like the one we're in right now once you understand what it shows. So it works like this: higher prices on a product, less demand from consumers, but more companies are willing to sell or supply the product at that price. Lower prices means more demand for consumers. Yes, I will buy 2 coffees if they're both half off, but fewer sellers want to sell at that price. And so there's always this tug of war between consumers and suppliers on what price they should use. And the point where these two lines cross is the ideal price to sell the product at, where you get the most happy consumers and the most happy sellers. Now in the real world, you find that price through competition, the back and forth of raising prices, offering discounts, hunting for bargains that we see in our everyday lives. But if we apply tariffs to this chart, we have to artificially raise prices since we need to pay for the extra tariff costs. And this sucks a big chunk of money out of the market in the form of taxes. But it also loses some of the transactions that people just can't afford anymore. And it may look abstract on this chart, but these two triangles here showing losses represent companies going out of business or consumers, regular people, not being able to afford the things that they used to be able to. And that is the cost of tariffs, even if you are trying to help the home team. And that's the idea behind these policies. Yes, tariffs hurt the US, but if they hurt the other guy more, maybe it's worth it. Kind of like embargoing a country that sells oil. It might spike prices here temporarily, but maybe it's done to achieve a very specific strategic goal. So is that what's happening here? And who's going to benefit from that goal? Well, back during the president's first term, his administration put tariffs on around half of Chinese goods, saying the Chinese government was stealing US IP, manipulating their currency, and unfairly subsidizing certain industries, like electric cars. Basically saying the Chinese government is putting their finger on the scale, so the US will put their finger on the scale to try to balance things out. Would it be better if neither side had fingers on the scale? Yes, absolutely. But you don't want to let another country unfairly get a monopoly in EVs. So most people let those tariffs go without too much complaint. But remember, the goal is always to get the fingers off the scale. Tariffs are the last resort option. It's like a standoff in an old Western. If no one shoots, everyone is better off. But once someone starts it, it's really hard to calm things back down. So that brings us to today's tariffs and the massive effects that they've been having on the stock market. And quite frankly, in this case, I think the US is the one who decided to start this standoff. We are now seeing a 10% tariff on all countries, including ones that are not suspected of having their fingers on the scale in any way. And even though during the Trump administration's first term, they put tariffs on China to try to force companies out of there, it is now putting heavy tariffs on the countries that the US companies moved into when they were pulling out of China. For example, there's a 46% tariff on Vietnam. And so US companies broadly are extremely unhappy about this, since they did what the government wanted. They moved out of China, and then the goalposts moved. This is partly why US earnings forecasts have started to drop steeply. But I want to look at a specific example of how a fully US tech company could be affected by these tariffs and how that is the canary in the coal mine for the entire US economy. And then we'll get to 3 stocks that may actually outperform during the troubling times ahead. So let's go look at Apple. Apple has on and off been the biggest company in the world, and they have massively spread US influence abroad. In fact, China and Russia have actually been fearful of how successful US tech companies in general have been at expanding globally. This is a company that employs a huge number of Americans, is one of the biggest drivers of the S&P 500, and helps the US broadcast its soft power abroad. And so Apple makes a really good example for the tariff situation because they have a truly global supply chain. They use raw materials from Africa, which go to Taiwan to become chips, which get designed in the US, added to phones built in China or Thailand, and then shipped across the globe. This allows their US employees to focus on high-paying jobs like design, software engineering, and marketing, while less valuable jobs go to third-party providers or areas where costs are lower. But with the new Trump administration tariffs, even ignoring the reciprocal tariffs for a little while, Apple will have to pay the 32% Taiwan tariffs to import their own chips to be added to their iPhones. So since Apple's gross profit margin is roughly 50%, if they wanted to maintain their margins, they would now need to increase their prices by the 32% tariff plus their margin on 32%, or 48% in total, taking a $1,000 iPhone to $1,400. And if you then tack on reciprocal tariffs, you could be looking at a $1,700 to $2,000 iPhone. Now, I'm not saying that's going to happen. It's just to illustrate how tight margins get when tariffs stack up. And Taiwan is on the list of countries whose tariffs have temporarily dropped to 10%. After it appears the administration was spooked by the US bond market values absolutely plummeting. And now, literally as I'm filming this video, the government has announced that they will exempt phones and computer chips from tariffs. It's just so chaotic, the moves that are being made right now, that it's hard to even cover what's going on. And this is just a YouTube video. Imagine you're a multi-billion-dollar company trying to plan months in the future what you need to do. So that's all what's kind of hanging over companies' heads right now. They don't know if iPhone prices are going to need to double until 3 days after the tariffs have already technically taken effect. So you're looking at potentially double the price with no extra profit. The government just takes all the extra money. And if that were to happen, people outside the US would probably just stop buying iPhones because they're not being tariffed, so they can still buy Chinese smartphones. And then in the US, demand would probably drop as well from people just buying fewer iPhones. And then Apple would have to lay people off. You have rising prices, rising unemployment, lower stock market. It's not surprising that the president is worried about potentially causing an accidental global recession. And so on the one hand, Apple has to plan for something that could destroy half their business, and then on the other, they have to adjust to whatever the government is saying at the moment. But how do you plan when the ground is moving underneath you? So since the stock market hates uncertainty almost as much as it hates bad news, just the threat of tariffs was enough to drag down valuations for the vast majority of US companies, including some companies that may actually benefit from tariffs in the long term. So I'll walk you through 3 stocks that might benefit in a bit, but to understand why they would benefit and why the market is still reacting so negatively, we need to zoom out. If the tariffs are this damaging, why are they still happening? Could there be a long-term benefit after short-term pain? So it's easy to feel uncertain in times like this. So I like to focus on what you can control. And one of those things is your personal private data, because right now it's probably being bought and sold without you even knowing. You might have seen those people search sites where you can see people's personal information from their phone numbers down to where they live. And this is because data brokers will scrape the web for every piece of information they can find about you and sell it to the highest bidder, often without caring who they target. And this data is out there available for robocallers or even straight up scammers. I basically never answer my phone if it's an unknown number, but nowadays people are scamming by combining your personal information with AI voices to scam you, or maybe more likely, your loved ones. And this problem isn't going away. Data breaches went up 72% year over year last year, which is where Incogni, today's sponsor, comes in. Incogni automatically contacts these data brokers on your behalf and forces them to delete your personal information. This is something that you can do manually. Like legally, these services have to delete your data if you ask them to, and I actually tried to do that once myself. I spent an afternoon going through one by one, requesting that they remove my data from the people search sites, but I got through maybe 5 of them, I kept finding new ones, and I gave up. But Incogni scans for your data everywhere to remove it, something that would be like a full-time job if you did it yourself. And with a yearly subscription, they will continually monitor these lists to make sure your data stays private. So I've been using Incogni for going on 7 months now, and it's been great. They immediately removed me from a few dozen sites, and today that number is up to over 500 removals, saving me an estimated 398 hours. And you can use code FinTech at the link below to get an exclusive 60% off an annual Incogni plan. So big thanks to Incogni for giving me one less thing to worry about and supporting the channel. And now let's look at why these tariffs were put in place so we can understand which stocks might benefit in the short and the long term. Okay, so we know that these probably aren't being used to generate revenue for the government, so they likely fall into the second category. They're being used to punish another country. But for what exactly? Well, in that famous chart that President Trump held up during his speech, I actually made my own version so I can look like a real YouTuber with props. The column next to each country showed the tariffs charged to the US, currency manipulation, and trade barriers. And this sounds pretty impressive in principle, but in reality, it's politician speak for a trade deficit, when we buy more from these countries than they buy from us. But what's odd is a trade deficit isn't always a bad thing. Let's take Taiwan as an example. The US buys far more from them than the US sells to Taiwan, but we more than make make up for it by selling our technology to the rest of the world. Without Taiwan, there never would have been an Nvidia. Second, these trade imbalances are partly why the US dollar has so much power abroad. Everyone wants US dollars since it's the trade currency of the world. So if we get rid of the trade imbalance, it could actually weaken the dollar's influence. Oh, and number three, we're going to have some insane shortages of goods from US companies if they can't afford to buy the parts and raw materials that they need. So the whole tariff scheme comes from this guy, Peter Navarro, who it appears learned about tariffs by reading a history book from the 1800s and drawing the exact wrong conclusion about why the US emerged as a superpower. Even Elon Musk has recently been feuding with him, and he had some harsh words for Navarro, calling him truly a moron and dumber than a sack of bricks. I know Elon doesn't really mince his words, but man, I would love to see what those two are like in a room together. And look, I don't know anything about Navarro to say anything about him personally, but I can confidently say that tariffing most of the globe to try to level out trade between other countries is kind of like cutting off your nose because it was itchy. Free trade is supposed to be a win-win, and if one side benefits more, good for them. The US still benefits. Tariffs are a lose-lose, and if one side is hurt more than the other, that doesn't help the US. So what am I doing in response to these tariffs, and what stocks might actually benefit in the long term? Well, if you've watched this channel before, you already know that any investing plan that doesn't account for market crashes is not a great plan. So I will continue to dollar cost average into the market as I talked about in this video. But let's take a look at 3 stocks that may outperform during the coming months if the tariff uncertainty continues. So number 1 is Rockwell Automation, ticker symbol ROK. This company is a leader in industrial automation software, robotics, and control systems. So if tariffs do force companies to manufacture more goods at home, their only chance of remaining competitive on a global stage will involve huge investments in automation. And while the recent market dip has hurt this stock in the short term, there are some signs that the company will see increased demand from future tariffs. See, even before the Trump administration took office, we were seeing a general trend toward more onshoring of manufacturing in the wake of the pandemic and the global supply chain issues it caused. The US wanted to make more things closer to where they were sold. With legislation like the Infrastructure Investments and Jobs Act, the CHIPS Act, and the Inflation Reduction Act, all providing incentives for increased US-based manufacturing. So this company offers a strong dividend of 2.3%, and while the company did see some reduced growth in 2024, the company's overall income looks fairly steady, especially given their recent investments in AI and automation may soon begin to pay off. I would classify this as a medium risk, medium reward stock. But number 2, we have a much larger company that is benefiting from the same trends as Rockwell, but is at a much bigger size. Eaton Corporation, ticker symbol ETN. So this company specializes in manufacturing electrical equipment, power systems, and industrial components. They sell things like circuit breakers, motor electronics, aircraft fuel systems. So they have pretty broad exposure to the US manufacturing base and anyone who needs electronics. In early 2025, Eaton announced their spectacularly timed investment in South Carolina, with the company spending more than $1 billion since 2023 on manufacturing its electrical solutions in North America. In fact, 43% of the company's revenue came from their Electrical Americas segment alone in 2024, and the company already had a backlog of orders at the start of the year while seeing record profit margins. And so since reshoring of industry has been a megatrend that's been underway for a couple years, it is also one of the investing trends that tariffs aren't likely to disrupt too heavily. Which leads us to stock number 3. So the only thing that the markets hate worse than bad news is uncertainty. Uncertainty breeds volatility, and that's how you get these huge swings up and down in price that feel incredibly stressful for any investor. I know my heart can't deal with that kind of volatility, but it doesn't have to. The iShares MSCI USA Minimum Volume Factor ETF is an ETF that is on the pricier side in terms of expense ratio. This ETF is less about massive growth in a short amount of time, but it tracks the least volatile stocks in the entire US stock market. For that, you'd be better off watching my top stocks video. This ETF is all about reducing risk and volatility in the core of your portfolio. Now, during this video, I made some pretty strong statements against tariffs, and I want to be clear that I'm not making a general political statement against one half of the country or the other. I simply believe believe the best strategy is to always follow data over emotions. And I've seen too many people trying to adjust the data to fit their position rather than adjusting their position to fit the data. I think the market is pretty clear that it wishes the government never ordered these tariffs, and there are real people hurting because of them. And it may get worse from here. In fact, I'm sure that at some point in the future it will, even if it's 20 years from now. But in the long term, focusing on finding great stocks, regardless of what's happening in the overall economy, is still the best way to build long-term wealth. And you can watch this great video next. You don't have to pay any tariffs, and YouTube is recommending the best video specifically for you, so check it out.